Are you worried that your estate might be subject to federal estate taxes, or you just want to gift money to the next generation to see them enjoy your money while you're living rather than after you're gone? Hi, my name is Zach Morris with Paces Ferry Wealth Advisors, and today I want to talk to you about a number of different strategies you can use to move money from your estate and from your net worth to the next generation and do it tax efficiently. In 2017, Trump passed something called the Tax Cuts and Jobs Act of 2017. And this bill increased the total lifetime exemption, the total amount that somebody could pass from one generation to another. Today, it's a index for inflation. It went up to 13.61 million per spouse. So two spouses can pass 27 million to the next generation with no estate taxes. The administration at the time was able to pass the bill through a process called reconciliation, which is a fast-track procedure that is able to bypass regular voting protocols. Now, reconciliation has something in it called the Byrd Rule, which basically means that the reconciliation bills can't increase the budget deficit outside of a 10-year window. January 1st, 2026 would be the end of that 10-year window. Because of that, the estate planning laws that were put in place in 2017 are set to sunset at the end of 2025. So 13.61 million per spouse, or 27 million for a married couple, roughly 27 million, is set to revert. Most professionals think it's going to go back down to 7 million per spouse. Now, if nothing changes, some of the strategies that I'm going to talk to you about could be very advantageous for lowering your taxable estate. So right now, that elevated lifetime exemption of 13.61 million is an amount that any person can pass to the next generation with no federal estate taxes levied on that transfer. So it could be passed at death, or it could be passed during their lifetime. So one strategy that I want to touch on today is something called freezing the value of your estate. We're not going to go into it in depth, but essentially, if you were to move 13.61 million out of your estate, and let's say it goes into an irrevocable trust, you're basically freezing the value of your estate at that amount. So that 13.61 million goes into the trust at that amount. You're using up your lifetime exemption of that amount. And if you die 25 years later, and that trust now has that 13.61 million is now worth 40 million, none of that is included in your estate. So you froze the value at 13.61 million. So that's a sophisticated strategy. And of course, any of these strategies you want to do in conjunction with your estate planning attorney and CPA. The other strategies that I want to talk to you about are much simpler and don't require the need of any trust or complicated estate planning in order to put them in effect. So the first everyday strategy that I want to talk to you about is utilizing your annual gift exclusion. So in 2024, this is $18,000 per spouse or per individual. So you can give $18,000 to any one individual. You can give it to your best friend, your kid, your grandkid, whoever you want. And that is not counted toward that lifetime exemption. It doesn't go against that 13.61 million. Now, that 18,000 can also be multiplied if you have a spouse. So you and your spouse can give 18,000 to a child, right? So you can give 36,000 to that child. If that child is married, you could give 36,000 to that child. Okay? And then you could also give 36,000 to each grandchild. So for the sake of illustration, let's assume you have 3 kids and they're all married, right? So you have 6 people that you can give gifts to there. Now let's assume that each couple has 3 children, right? So you have 9 grandchildren, 3 children that each have spouses. So you have 15 individuals that you can gift to in any one year. So if you'd like to keep your taxable estate down and gift money every year, in this example, you could give $540,000 without using up any of your lifetime exemption. So that 13.61 million stays intact. You didn't use up any of it, and you could give $540,000 each year. So if it's the end of the year, you can give $540,000 that year, and then $540,000 at the beginning of the next year. So the next strategy that I want to talk to you about is 529 plans. So 529 plans allow for something called superfunding. So I'm specifically going to talk about the superfunding here and not go into as much of the details behind a 529 plan because we're talking about estate planning here. So in superfunding a 529 plan, you're able to give 5 years worth of gifts in 1 year. So think about that. You're able to give 5 years worth of gifts in one fell swoop. So if you have 9 grandchildren, you can give $36,000 to each one of those grandchildren into their 529 plan. But with the superfunding, you can give 5 years worth of gifts. So you can put $180,000 into each one of those grandchildren's 529 plans. So with 9 grandchildren, you can gift $1.62 million, $1,620,000 all at once, and that does not go against your $13.61 million worth of lifetime exemption. I'll say that again. In this example, you can give $1,620,000 all at once to the next generation, and it does not go against your lifetime exemption. It only counts toward your annual gifts. Now, you're using up 5 years worth of gifts in this example. So when you superfund, you're using up 5 years worth of gifts. So you have to live past that 5-year mark in order for all of that money, in order for that $1,620,000 to not be included in your taxable estate. If you die in year 4, 20% of that gift is then going to be pulled back into your gross estate. You don't have to pull that money back out of the 529 plan. You've given that to your grandchild and it's theirs. However, the amount, 20% of the total gift, would then be calculated as part of your gross estate. The next strategy that I wanted to discuss with you is paying education expenses directly to the school. So you can pay education expenses directly to the school, and not only does it not go against your lifetime exemption, it also doesn't go against your annual gift. So you can maximize your annual gifts to your children and your grandchildren and pay educational expenses directly to the school. So you can maximize both. So if you're regularly gifting to your children and you want to maximize the amount of money that you're transferring to the next generation, you don't want to give money to your child and then say, hey, I want to help you out. Why don't you go pay for school with this gift? What you want to do is give them that money, give them the $18,000 or $36,000, and then turn around and pay the school directly. Because when you pay that school directly, it's not considered a gift. And so you're able to pay them the $36,000 as well as pay for school directly. And you're really maximizing all of the vehicles that you have available to you to lower your taxable estate and pass money to the next generation. The last option that I want to talk to you about is paying medical expenses directly to the provider. So just like paying educational expenses directly to the school, if you pay medical expenses directly to the provider, it does not go against your lifetime exemption, and it also doesn't go against your annual gift. So in summary, you can pay educational expenses directly to the school, and it does not count against your lifetime exemption or your annual gift. And you could pay medical expenses directly to the provider, and it also does not go against that lifetime exemption or your annual gift. If you've enjoyed this video, please subscribe below and give it the thumbs up, and be on the lookout for more videos from this channel. Thank you.